It is monthly Q&A time here again on the channel. I recently put up a community post here on YouTube asking for your questions for a Q&A video, and this is that video. Now, in that post, I did also include a picture just for the algorithm. YouTube community posts tend to like when you attach a picture to those posts. So I put up a picture of me and Lilu. There is a little bit of confusion from some people that I was actually doing a Q&A session with Lilu. Unfortunately, you're stuck just with me for this video, but hopefully I can give some decent answers to your questions nonetheless. Now, I'm going to basically start with some of the top rated questions and who kind of got in there first and asked questions most quickly on those posts. So if you want to get a question in for a future Q&A video, just turn post notifications on or your notifications on for the Investing with Tom YouTube channel, and you should be notified whenever I put up the next community post for a Q&A video. So that is the topic of today's video, but before we get into that, we do have a sponsor for this one, and this video is sponsored by Hatch. Hatch is the platform that I personally use for all of my US investing for me as a Kiwi based here in New Zealand. And Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things that I want to do tomorrow. Everyone's tomorrow looks different, whether you want to buy your ultimate dream car, travel the world, or become financially independent. Reaching your goals starts by taking the first step. That's why I invest with Hatch to help make my plans a reality. If you want to get started investing with Hatch, check out the first link in the description where you can get a free 20 New Zealand dollar top up when you make your first deposit of 100 New Zealand dollars or more before the 31st of December 2022. Okay, let's kick things off here with a question from my guy Frank Tabor, the unofficial king of value investing threads on Twitter, I would say. And Frank asks, do you think investing in small illiquid companies is an edge for retail investors? If so, what percentage of your portfolio is in microcaps? Yeah, good question. I think you might have asked me this before, Frank, so I'm guessing you know most of my thoughts on this topic. But yeah, I think common sense, common logic, I guess, would tell you that generally speaking, the less followed and less liquid that a company is, the more likely it probably is to be mispriced. If you look at some very tiny little microcap, with a market cap of like $20 million, for example, there's probably not going to be many analysts following it, and there's probably very few professional investors that can get reasonable amounts of capital into those companies. Whereas if you go right up the other end of the spectrum and look at Microsoft and Apple and so on, they're obviously very closely followed companies, and people have the capacity to put a lot of money into those businesses. So generally speaking, I would say that you're more likely to find mispriced companies in the smaller microcap kind of world. Now that said, if I had to generalize a little bit, I would also say that the quality of company and long-term track record of the businesses tends to probably be lower on average in those smaller companies, but you can certainly find some high quality businesses down there as well. So yeah, I think it's an edge. That said, I think you can find undervalued companies in all different market cap ranges. I don't think you should kind of restrict yourself necessarily to just microcaps or just large caps. I think you could kind of look everywhere, but if you were to focus on one particular hunting ground, small caps is probably a good place to go. And second part of your question, if so, what percentage of your portfolio is in microcaps? I think the technical cutoff for microcaps is 300 million in market cap from memory. Someone can correct me if that's slightly off, but I actually don't think I have any of the portfolio in that range at the moment. Something like Seritage Growth Properties may have got down to that market cap at one point in time, but it's rebounded a little now. But in saying that, I think the only company over, call it $5 billion would be Alibaba and my one token share of Berkshire Hathaway. So almost all of my portfolio is somewhere in the, call it a little under 1 billion to up to maybe $5 billion range. But like I say, that's just me kind of searching through different opportunities, swinging at opportunities that I like, and that's kind of just how things have come out in the wash. I'm not necessarily trying to have a certain portion of the portfolio in particular market cap ranges, but good question, so thank you, Frank. Okay, next one here is from Gage. Monish Pabrai talks about the several types of value investing: multi-baggers, 50-cent dollars, special situations, etc. Do you tailor your portfolio to one of these models, or go generally for outsized safe returns? Yeah, I try to just look at everything. I guess a little bit like Frank's market cap and liquidity question. I don't restrict myself to one sort of area, but I do try to look at everything. And I think Monish Pabrai himself even has probably drifted towards more of the compounder type businesses over the last couple of years. So I don't know that he would be as interested in weird special situation type opportunities anymore, unless they were kind of wrapped up in a compounder. Like Process is probably a good example, where he's potentially got this weird discount to net asset value aspect, as well as the long-term 10-cent compounding aspect too. So I will look at everything, and I think Monish Pabrai probably used to look at everything and is maybe focused more on those long-term compounders these days. Next question, I won't say your name on a video just in case YouTube doesn't like it. Pick one stock you invested in the past. Take us through what you're thinking / looking at before investing in the company. Then take us through what you're thinking when you sold. What changed? Do you still follow the same process? Thanks, Tom. Yeah, good question. If I maybe use a mistake is probably the most beneficial to talk about, and a business that I don't think I've covered in a dedicated video since completely getting out of it a little while back, would be something like Graftech. I invested in Graftech maybe 3 years ago now, something like that. It was a clone of Monish Pabrai, where many of you that were watching the channel at that time will probably know roughly what the investment thesis was. It was basically Graftech as a commodity type business that produces these graphite electrodes. They are a essential component of electric arc furnace kind of methods of producing steel. And the kind of valuation aspect of it was quite straightforward. They had these locked-in contracts. We thought they were going to produce basically their market cap and earnings in the next 3 to 5 years, and would get basically our cash back in that time, and then would still own the business at the end. That was kind of the investment thesis. In terms of what happened, I mean, Graftech actually more or less did earn that amount of money. They still trade at like a PE of 3 or 4. The market cap really hasn't moved that much, so the earnings component of that thesis turned out to be roughly correct, maybe slightly optimistic, but it was certainly in the right range. What really went wrong, I think there were 2 things that I missed, and I've evolved a lot as an investor in the past couple of years, and these are 2 things that I would pick up in a second today, I think. And I'm unsure really why Monish Pabrai wouldn't have picked these up a couple of years ago. But anyway, firstly, Graftech had a lot of debt, so if you looked at it on a market cap basis, sure, they would earn their market cap in 3 to 5 years, but they had a lot of debt, so they would earn their enterprise value in closer to maybe 6 years, something like that. Might have even been a little bit more. So firstly, they probably weren't quite as cheap as they might have initially looked if you considered things on an enterprise value basis. And the other thing was capital allocation. We didn't really have a clear picture of even though they were going to earn all this money, was it actually going to be returned to shareholders? Or would it be used for, some other means? Would it be used for an acquisition or to repay debt when we would prefer to get a dividend or that sort of thing? And during the pandemic, the capital allocation changed as well. So they wildly cut back their dividends. They did focus on debt reduction, which for the long-term future of the company is probably not a bad decision, but it changed the equation to where we didn't get that capital returned to us, which was really the original thesis, that they earn all this cash in a relatively short space of time, we get all that cash back as a shareholder, and then we still own the stock kind of at the end. So that's an example of what changed, and those are 2 things that I really would pay a lot of attention to these days, is debt, and it's one thing to earn a lot of money, it's another thing to understand kind of where that cash is being allocated. And Graftech in the end wasn't a big permanent loss of capital for me or anything like that. On some of the purchases I made money, some of the purchases I lost a little bit of money. They actually just pulled it up in ShareSite here. So I had capital gain of minus 2.5%, dividends of plus 0.8%, and I lost a little bit on the currency, was down about 4% on the currency. So by and large, I lost about 6%, call it, of the investment. I ended up rolling the vast majority of that cash into other more attractive companies over a period of time. So it wasn't a big permanent loss of capital, but I learned some things from it, and there was probably a bit of a opportunity cost thing from having some money tied up in Graftech for a period of time. Okay, next question here is from John. I recently did a check of value super investor portfolios and found that 84% held Meta as a position. It's also the case that most paid a significantly higher entry price than today's price. Is this a position you hold, and could this be considered an even better value prospect than Alibaba, for instance? Yeah, sure. I guess one company can always be considered a better value prospect than another company. It really comes down to how much cash you think those two companies that you're comparing will throw off in the future, between now and Judgment Day, as Buffett always says. How much cash will the business produce for you as an owner, and how much are you paying for the business to get that cash as an owner? And if you have a different view to another person, you might come to a different conclusion as to whether Alibaba or Meta is a better value prospect. So no real comment on which one I think is better. I have Alibaba in my portfolio. I don't have Meta. Not ruling it out if prices change or if my view changes. The portfolio may change. Do your own work and come to your own conclusions on those things. But that's kind of the way I think about it, at least. I would say that there have been some big changes in Meta. Obviously it used to be called Facebook, and the name change is an indicator of kind of what they've done with the core business, or what they're looking to do with the core business. So there's a lot of future R&D spend that will take a lot out of free cash flow for owners. And, you have to have a view on what that will actually produce. And if you don't think it'll produce anything, maybe Meta doesn't look as attractive. Maybe you have a view that if it doesn't produce anything, their ads business is still good enough to, offer you a good return. So I think things have probably changed for some of the super investors that do own it. But, of course, there are a lot of people that still think that stock is attractive. But as always, do your own work on that one. Okay, next question here is from James. Will you go to Omaha again? If so, would you stay longer next time? Yeah, good question. I don't see myself going to Omaha to the Berkshire meeting every year. I would love to, but it's a long way to go and a fairly expensive exercise. But I would certainly really like to go back again. I guess I will probably have to do that sooner rather than later, just given the age of Warren and Charlie. But it'll also be interesting to see what happens with the Berkshire meeting after Warren and Charlie are no longer there. So I would definitely love to do it again in future. It was a super cool experience. And would I stay longer next time? We were in Omaha for about a week. I think that was plenty of time in Omaha. We were there a few days before the Berkshire meeting and got to a few events before the meeting. And then we stayed on for a few days after and, had a bit of a look around Omaha and that sort of thing. So I think that was a good length of time, maybe even slightly, we could have even probably done it slightly shorter. But I think that was a pretty good way to go. And would I stay longer in the US generally next time around? Yeah, I wouldn't mind exploring other parts of the US a little more than we maybe did. But got to have a decent look around Texas. Hamish and Brandon carried on to Florida as well, which I didn't do. So lots of other places for me to see, of course. Would love to explore more of the States in future. So thanks for your question. Next one is from Daniel. Tom, could you mention some good resources for portfolio construction? Second, a number of videos on YouTube have spoken about Berkshire's cash pile and how handy it is for them to have cash during this correction. How would they plan that? Shell PE? Yeah, sure. So the second one's easy. I don't think they're sort of planning it in any way. They are not market timers. They've said for a long time that they are not market timers. Historically, though, they have tended to have more cash when markets get expensive, and then therefore when they kind of come back and correct downwards, they've tended to be able to do stuff with that excess cash. But I would say that's really a consequence of just looking at the opportunity set and saying, we find this interesting, we'll put some cash towards that. Maybe we don't find much interesting at the moment, so we'll wait for something better. So really just by the nature of their investing approach, they tend to accumulate cash when stocks are more expensive, and they tend to have very little cash when stocks are cheap. So I don't think that they're planning it by looking at a Schiller PE or anything like that. And any good resources on portfolio construction? I must say I haven't dug a lot into portfolio construction or spent a lot of time on it. I tend to roughly equal weight positions these days, but maybe with a bit more weight towards a higher conviction idea. So that's how I think about it, but there's a lot of different approaches to portfolio construction, so don't just copy me on that one. Next one is from Quant Compounder. Do you believe cash account balance and all the associated transactions, deposits, interest payments, fee reimbursements, withdrawals, fees, and interest charge should be included as part of an investor's overall performance calculation? It isn't included as part of ShareSite's performance calculation currently, but I've been told there is an open ticket investigating the possibility. Yeah, interesting question. I mean, all of those things are real costs and will genuinely pull your return down. I do know you can add cash to ShareSite, and you can add things like brokerage costs, but the other parts are certainly a little more challenging. So should it be added to your overall return? I mean, possibly. Again, whether that will actually change sort of your behavior and actually change your long run results, as to whether you're tracking that or not, I don't know. Maybe for some people it will become more obvious that cash drag is a thing, and of course to get more fully invested or something. If you think that's you, maybe it is something you want to track. For me, I tend to just kind of look at opportunity after opportunity, and if I think something makes sense, I'll put cash towards it. And I don't think that tracking those things would necessarily change the way that I go about that process. But yeah, interesting question. Next one is from Henry. Hey Tom, hopefully you'll get to answer this one. Yes, I am Henry, so thanks for the question. I'm wondering if you have ever backtested your favorite guru investors' most recent portfolios. Obviously these guys have huge reputations, but have they been tested? It would be easy enough to do. Yeah, I know Brad Kellner, Stock Compounder, has done a little bit of his own maths on Monish Pabrai's portfolio, what your results would have been had you just cloned Monish. But some of these investors do have public track records, so I don't think you would necessarily need to do all the maths yourself of backtesting these things. I mean, Guy Spears' annual reports are now public, for example. Warren Buffett, obviously at Berkshire, has all his information public. Rob Vinal has his info reasonably easy to access. I know there's the occasional Monish Pabrai letter that will get floated around the internet as well. So I don't know that you really have to do a lot of that backtesting yourself. But it is interesting to follow that stuff. And interestingly, a lot of those investors that I just mentioned will have actually lagged the market over the past several years, and that's probably pretty normal when we've got these big quick run-ups in prices driven by a bunch of tech stocks or whatever, which have now very much come back to earth. I think you can see those investors lag a little bit, and hopefully they're kind of now shining relative to the market in the last year or so. But yeah, most of those guys will have good reputations for a reason, because they have good track records, and sometimes they're easy to find, sometimes they're not, but I don't necessarily think you need to do a lot of back testing or anything like that. Next question is from Kubaz32. When will the podcast with Jason be out? Yep, so I did a podcast with Jason Rothman, the After Dinner Investor. I just recorded that on Saturday, so hopefully it should be out kind of late this week, maybe sometime over the weekend or early next week at the latest, but excited to get that one out. Next question is from Just One. What is the biggest thing people miss about Thor, in your opinion? If you've spoken about this in detail, sorry for asking. Yeah, no problem. Biggest thing people miss about Thor, I think probably the management track record and just the candor of management and that sort of thing is probably underappreciated. I think they're one of the better teams out there for sure. A lot of alignment with shareholders, so management is an easy one to miss in a lot of businesses, good or bad management teams. So I really like the management of Thor. That's probably one. I also know that Thor, almost right off the bat, always get called a cyclical business, and they do go through ups and downs, but they're not like a cyclical business in the fact that they would, in the respect that they would lose money, every second or third year, like a commodity business would, or you know, automaker would when they go through a downturn. Thor's been profitable for over 40 years straight at this point, and each downturn they've gone through, they've been more profitable than the previous downturn. So yes, they go through ups and downs, and you've got to kind of normalize a little bit, but they don't go through anywhere near the extremes of some other kind of cyclical businesses. So let's maybe do one or two last questions. This one's from Arav. If you could spend an entire day in the office with any investor in the world, which one would it be and why? Good question. I think it would probably be Warren Buffett, or possibly maybe even Lelu would be interesting actually as well. I think I have a reasonable idea of what maybe Warren Buffett's day might look like, with reading and being on the phone with his company managers and that sort of thing. But I would like to see how Lelu works and understand, you know, what investigating a new company, you know, might look like. So that would definitely be an interesting one to do. Let's do this last one from Homespace. I haven't watched YouTube much over the last year, but wondered if you managed to buy a house yet. Prices are dropping with the rising interest rates in NZ. How much do you see them falling back? Yeah, sure. I don't want to make housing market predictions, so I'm not sure on how much they'll fall back, but certainly house prices, from what I've seen, anecdotally have been coming back when I've been out in the market looking at houses, and the stats it's now starting to show up, particularly in Wellington. That market is starting to get a bit of a hammering, I think, down something like 18% now in some parts of Wellington. So some pretty serious drops starting to happen. I will edit this out of the video if something goes wrong, because I don't want to jinx it, but we did have an offer accepted on a house very recently, so fingers crossed that continues to go smoothly and we finally have that one across the line. So thank you for your question there, Homespace. Okay, so that is all we have time for this video. Thank you very much if you asked a question. I apologize if I didn't get to your question in this video, but thank you to everyone who did ask one. And like I say, if you want to ask a question in a future Q&A video, just keep an eye out for those community posts. I always post there for these Q&A videos to collect your questions. So that's really it for me for this one. I do hope you enjoyed the video. If you're interested in the hatch offer, head to the link on the screen here, which will also be down in the description, to get your free $20 top up. And I will see you in the next video. Cheers.